time.
Yeah, so my name is Greg Hunter. I'm going to talk to you today about the financial analysis of the Glenn County Federal Employee Credit Union. And it's the results for the 2008-2009 years. The outline is we're going to cover the overview, then we're going to talk about the economic environment of 2008 and 9, some of the major findings of the financial analysis, profitability, employee productivity, asset quality, and capital adequacy. And then we're going to talk about asset liability management, and then the summary of the financial analysis. We're going to close it out with that. So the credit union itself is actually based in Brunswick, Georgia. The size, the assets is roughly at 15 million, and employees is 6 during the years of 2008 and 9. The history of the credit union itself is the membership eligibility is the federal government employees to include active duty reservists and retired military, which is kind of near and dear to my heart. And the credit union commenced business in 1953, so it's been around a little while. Credit unions products offered is the credit cards, vehicle loans, which is auto, boat, and RV, some mortgages, first mortgages, medical expense loans, and loans like that. So the knock on the effects of 2007 credit crisis severely dampened economic activities. There were several major banks that defaulted, and that came around because of interest rates plummeted, unemployment levels soared, housing values fell to less than, by more than not 30%. There was a great deal of foreclosures, hit the record highs, and credit union loans, delinquencies, and defaults had increased dramatically. Some of the major findings, 2008 and 9, the Glenn County Credit Union profitability was significantly better than most of its peers. In 2008, the Glenn County Credit Union was more profitable than 90% of its peers. The Glenn County Credit Union's profitability increased, as measured by return on asset, increased from 0.44% in 2008 to 0.76% in 2009, while most of its peers booked a loss over that year. In 2008, Glenn County Credit Union was the top of 10 percentile of its peer group in terms of profitability, and the top 20 percentile of 2009. The credit union was profitable during the financial crisis of 2008-9, while its peers experienced losses in 2009. The profitability is actually measured in return on assets, and in 2008, the credit union had gained 0.44%, which is 44 cents for every $100 loaned, while its peer group was at 30 cents. And that put it at greater than or better than 90% of its peer group. In 2009, it was very similar. It increased, their return on asset increased to 0.76%, which is 76 cents for every $100 loaned out, while its peer group it lost 13 cents. So it looks like that the band or the outliers expanded a little bit, but it's really not. They actually dropped to greater than 84%, greater than its peer group. Employee productivity in 2008-9, the credit union maintained a good strategy for increasing its profitability. Although the credit union employee productivity on balance was below average, I'll show that their actual salaries are much higher than their peer, and they also had higher employee to depositors as well, which kind of this was the negative side of the credit union. So the number of employees per full-time employee is a productivity. The credit union ratio is roughly at 300, where the peer average is 448, roughly 450, which put it actually worse than 87% of its peer group. So that was their downfall. Even though they made a lot of money, the room for improvement, they could have done better here. In 2009, they actually got a little worse. The credit was roughly 290. Peer group is again around 450, which put it less than 88% of its peer group. The average loan balance itself, this is another room for improvement for the credit union. They actually loaned out 12,000, average of 12,500, where its peer group averaged at 9,200. So actually, it's inverse what I just said. They're better than 85% of their peer group. And in 2009, the credit union loaned out 13,000, and the peer group averaged 9,000, which put them better than 87%. Their salary to benefits, their employee productivity. Their actual salaries was $56,000 per employee. Peer group is $49,000, which put them actually at the 75%, or worse than 75% of their peer group. And in 2009, it stayed roughly the same. Their salaries at $56,000, peer group at $50,000, and again, it's around 70. They're worse than 73% of the peer group. Asset quality. Their asset quality was outstanding, very strong. In 2008, the delinquent loans were 0.7% of its total loans, and 0.38% of the total assets, better than 2/3 of their peers. The Glenn County's ratio of net charge-offs to average loans was better than roughly 90% of its peers. In 2009, Glenn County credit union ratio of delinquent loans to total loans was better than 3/4 of its peers, and the Glenn County ratio of delinquent loans was better than 70% of its peers. The asset quality on delinquent loans to total loans, 2008, the credit union was 70 cents, or 7.7%, excuse me. The peer average is 0.158, which is better than 69% of the peers. And in 2009, the credit union itself was 0.59%, peer average 1.78, and again, it's better than 75% of the peers. The capital adequacy for both 2008 and 2009, the Glenn County Credit Union level of capital was strong compared to its peers. Clearly, Glenn County has sufficient capital to support its loan portfolio and protect its depositors from the likely adverse impacts of any or all non-performing loans. So they were able to protect themselves from what hit all the other credit unions and banks in those 2 years. They were able to cushion or insulate themselves. The credit union ratio of net worth to total assets in 2008 ranked the top 10% of the similar sized institutions. Likewise, the Glenn County Credit Union total ratio of total delinquent loans to net worth was significantly better than the peer group average. Much like 2008, 2009, the credit union had impressive capital adequacy ratios. The credit union's ratio gave it a much greater capital cushion than most of its peers. The capital adequacy continued. The net worth of total assets, the credit union had 25%, roughly 25% net worth to total assets, and peer average was 14, which put it greater than 94%. 2009, it was nearly a mirror image of 2008 at 24%, peer average at 12%, and again, put it in the 94th percentile. Asset to liability management. Overall, the Glenn County Federal Credit Union asset and liability posture of December 31st was excellent position to comparison of its peers, given that many reasonable and knowledgeable parties expected prevailing interest rates to start a cyclical decline in 2010. The Glenn County Credit Union's asset liability posture was quite reasonable and didn't expose the credit union to any imprudent interest rates. That said, the credit union may have overprotected itself from the adverse impact of rising interest rates and sacrificed profits unnecessarily in 2008 and 2009. The asset liability management, long-term assets to total assets, the Glenn County Credit Union was at 12.7%, peer average was 18.73%, which put it into, it put it worse than actually 67% of its. In 2009, it was very similar at 12.55, the peer average 18.23, and then the credit union percentile again was at 33%. Short-term cash plus short-term investments over total assets, 2008 was 32.03%. The peer average is 25.1, which put it at the 73th percentile. And 2009 was very similar at 34.7, peer average 26.69, and the credit union percentile ranking was at 76. Asset liability management continued. The core deposits over the total shares of borrowers. The 2008 credit union was 83.18%, peer average is 56, which put it greater than 92% of its peers. 2009, the credit union was 81, which is similar again. Peer average is 56, close to 57, and the credit union percentile rank was at 90%. Asset liability, total loans, total assets. The credit union in 2008 had loaned $53 for every $100 of deposits, to compare to its peer average of 58, which put it worse than 63% of its peers. So they should have loaned more money. They had overprotected themselves, as I said earlier. by holding the money in their deposits instead of loaning it back out. 2009, they actually increased their percentage to $55 out of 100. To the peer average was 54. Peer average actually dropped. The peers actually insulated themselves a little bit more. The Glenn County Credit Union lent a little bit more, which put them at about the peer average, about 53%. Summary, the quality of the Glenn County Credit Union's loan portfolio and overall asset quality was well above average. This could have been excellent if there were higher total loans to total assets ratio, making what was a good return on assets a great one. Glenn County's level of capital was strong compared to that of its peers. Clearly, Glenn County has sufficient capital to support its loan portfolio and protect its depositors from likely adverse impact of any or all non-performing loans. Employee productivity headline, that's where I actually put in there that they actually paid their employees much higher than the average. They had a higher employee number to the amount of depositors average compared to their peers.